On today's hot sheet, I'm discussing housing inventory for the past 7 days, NAHB's home builder survey, and housing starts data. Today is Monday, July 21, 2025. I am Byron Lazine, and the hot sheet starts now. Live from Connecticut, here to kick off another week in the dog days of summer here. Middle of July, second half of July, when I start to hope and wish that summer would just come to an end. I like back to school, beginning of football. Haley's shaking her head. I can't wait for summer to be end. We get back to doing business as usual. How frustrating is it when everybody is kind of checked out for the summer? It only gets worse in August, but we're almost there when people have to get back to reality. I can't wait for it. We're in those dog days right now, and we're just going to take a look at where the market is. What signals do we have for the market moving into the second half of the year? Let me know where you're tuning in live from. Let me know. Jason Flory, just weeks away from NFL's. NFL's great, but it also, that fall season, people got to get, it's like starting the year. People got to get serious about business again if they were messing around all summer. I like it when more people are serious. There's an opportunity here, though, too, obviously, as people are checking out. You can check in, kind of gain steam. All right, the market and the rates, they're not gaining steam. We'd like to see some improvement here in the second half of the year. There may be one reason why we can be hopeful that we will hit that 6% by the end of the year. I'll break that down first. Let's get into the weekly inventory. This is one of those, we've been tracking this every single week. We do it every Monday. It's one of those things that's really important for buyers. And the more active single-family inventory on the market, the better the chance that there's downward pressure on prices. I get it. 40% of homeowners do not have a mortgage, and a whole bunch of those mortgage have a really low rate. That's locked up inventory and given, a lot of reason to sellers of not negotiating on price, but you're starting to see it. Sunbelt states and other places where there's enough downward pressure to create a more affordable environment for buyers. Inventory here for the past week moved up 10,000 after moving down the week prior. Remember, we've been over 850,000 on single family active inventory. That was 2 weeks ago. Then you factor in the week after 4th of July, we went from 853,000 to 846K, now up to 856K. So are we going to kind of just ride this 850,000 line, similar to what we did in 2019, where it was like 950, 960, 970 before the end of the year seasonal decline? Or will we increase from here to crack 900,000? That's what I'll be watching the most closely as it relates to active inventory. 28% more than last year. We've been up as high as over 30-something% at different points in this year. Remember, last summer, we continued to accelerate through the dog days of summer, the end of summer, and even the beginning of fall. We didn't peak out until October at 739,000. So will we create a new level, 900,000+? We're already over the lows of 2019 on active inventory. Get up over 900,000. That is a huge improvement. And you're going to hear less and less talking about how many millions we are short of supply to meet demand. If that was the case, a lot of this supply would be getting soaked up into the market. It's affordable supply. Okay, 3 to 7 million homes short to meet demand in this country. All comes down to how affordable it is. New listings for the week come in at 73,000 plus. The same week last year was just about 69,000. So if you're watching on YouTube, you can see the big jump off of the holiday week. Still well off of that 80,000 number that you look for on any given week. And for us to get back into that range here at this point of the year consistently, probably unlikely. Only hit it a couple times on the year as a whole. So new listings aren't really the thing that's helping us out on inventory as much as, hey, there's just some homes that are sitting on the market. And that's why this number's higher than you would expect it to be at this point in the year. 41.3% of properties have a recent price reduction. Typically, a third of homes will reduce before selling. Number higher than normal, 41.3% versus 39% same time last year. Expect this number to only get larger as we go into the second half of the year. So a lot of sellers are learning today's market isn't yesterday's market. There's some big differences in what's going on here in today's market versus what was happening 2-3 years ago. Pending home sales year over year has improved 66,000 for the week versus 61,000 the same week. We've kind of rode the trend line of last year, and that's why we see on total pending sales 386,000 versus 382. Again, very similar to last year. Well off of 2022's numbers, very similar to last year, very similar to 2023. The last 3 years have had a suppression on deals. Now, even though pending home sales weekly and total are a tick above where we were last year, it's still not showing up in total home sales all that much. We've got total home sales actually currently kind of sitting just below 4 million on existing home sales. And you're seeing more cancellations from these pendings than you would want to see. And it's just a lot of uncertainty, Jerome Powell's favorite word, in the market, which creates a pause for current buyers. There is a potential rather for future would-be buyers. We have 24 straight weeks of positive year-over-year data on mortgage purchase applications. And if you get rates that get closer to 6%, this number will swell, as we've seen on that momentum in the past. And then you'll obviously have more opportunities for those buyers to come out of the market. Now, what's the one thing helping us the most with in terms of rates? It's the spread between the 30-year and the 10-year. This spread is getting closer and closer to normal, which means we may not need the 10-year to come down all that much to get to 6% 30-year fix. This number continues to trend towards normal spreads. Remember, last year at this time, we were up at 2.6 on a spread. We're down to 2.3. This gets down closer to 2%. We could see rates, even with the 10-year sitting where it is today, comfortably come back on the 30-year fix towards 6%. That's part of the hope here as we go into the end of the year, as Jerome Powell has not shown any signs of wanting to cut the rate. We have next week an FOMC meeting week. We'll be obviously picking that up, closely looking at that and what those comments are next week as the committee meets and makes the decision probably to do nothing. Builder confidence here in July, it's been down month over month over month. But edges up in July. Builder confidence for future sales expectations received a slight boost in July. The One Big Beautiful Bill Act was one of the drivers for more higher confidence from builders. Elevated interest rates and economic policy uncertainty are the headwinds for the housing sector. We talked about this last week. Builders are in a really tough spot as the longer rates stay higher. They continue to have to make very tough decisions. Fortunately for the greater economy, those decisions haven't come with mass layoffs, but eventually the longer they have to hold on, that becomes a decision. Now, I talked a lot when the Big Beautiful Bill was passed about this being a tailwind for the economy and a tailwind going into next year in particular. I think there'll be more money flowing in 2026. The last piece of this kind of economic uplifting would be if rates come down, you will see a huge economic year in America 250. That's 2026 when America celebrates their 250th birthday. That's what the administration wants. The last piece of the puzzle here for them is to get the rates lower. The passage of the One Big Beautiful Bill Act provided a number of important wins for household, home builders, and small businesses. This is NAHB Chairman Buddy Hughes. who's a home builder and a developer from Lexington, North Carolina. While this new law should provide economic momentum, something I've highlighted a lot, after a disappointing spring, the housing sector has weakened in 2025. This is how builders look at it. Weak housing market due to poor affordability conditions, particularly from elevated interest rates. No question about it. As builders are concerned, they're seeing traffic go down, traffic on home tours. Okay. They pay somebody to sit in these model homes and they walk in and the sales representative is playing Wordle. Okay. Because they're not answering a lot of questions. Here's where the confidence is. It's essentially remains in the toilet. It's up from 32 in June to 33 in July. Anything below 50 is really bad on the confidence scale, and that's essentially where they're at right now. Taking a look at one other point here, just on current sales. Okay. Current sales expectation conditions rose 1.36. So that's currently what's happening right now. Sales expectations the next 6 months increased to 3 points. So to 43. So next 6 months, they're starting to warm up to the idea that, hey, maybe we can get rates down. Maybe this bill is going to be helpful. Traffic of prospective buyers fell. So they're not feeling the love right now on home tours. It's down at a 20. It's on a scale of 100. That's really low for builders saying, hey, here's where our traffic is at. Buyer traffic on their model homes and their sales is really down. And so current sales conditions are obviously down with that. Here, when just looking backwards on this housing market index, NAHB, Wells Fargo index versus single family starts. As these numbers come down, home starts are going to come down. We expect home starts obviously to come down over the next 6 months as builders take some of the risk off the table. Look at sales starts in the red, trying to catch up to confidence. Tried to catch up obviously during the 21-22 years. Now moving down as confidence continues to move down for builders in this current environment. Mostly, the biggest restriction for builders remains the elevated rates, and it's one of the reasons why you're seeing an administration that is putting a lot of their economic focus on Jerome Powell, the Fed, who meets next week, and on where those rates are. Building permits come in at 1.397 million. Speaking of housing starts, those are at 1.321 million. These are annually adjusted annual rates. And then housing completions coming in at 1.314 million. Permits down. Completions down. Starts look to be up month over month, and permits are moving sideways. So let's just take a look at where these numbers come in. Permits is 0.2% above May's rate. It's 4.4% below where we were in June of 2024. Housing starts is 4.6% above May. It is down year over year, a half a point. Expect this number in the future as we move into the second half of the year to come down. Single family housing starts in June were at a rate of 883,000, 4.6 below. So if you're looking at single family, those numbers did come in below May. So month over month, single family starts move down. Speaking to some of the concerns about builders, you're actually seeing multifamily be the driver on housing starts that move up. Why? Because less people are buying single family, which means they're going to have to live somewhere and they're going to rent. Even in the high interest rate environment, they're moving back to multifamily right now. The builders are, versus single family. There's less risk there. Housing completions, 14% below May's level of 1.5. You're seeing some delays from builders as they're just trying to make it month to month here. 24.1% below June's 2024 rate. Okay, housing completions. They don't want to complete a house that isn't going to sell. Put themselves in a different level of tax and upkeep and just carrying the property. The carrying costs on a completed house versus uncompleted is different for a builder. Obviously, you know that. All right. So completions plummets over the last 30 days. All right. Here's a look at single family starts in red versus total starts. This number here is widening. Builders leaning towards multi away from single family in this current environment right now. 10-year treasury starts the day here at 4.376. This is moving down a little bit, but still near the last 30 days highs and pretty much near the last 90-day high. But we don't need an under 4% 30-year, 10-year for the 30-year to get to 6%. We need the momentum we've seen on the spread to continue and this to move down a little bit. And you could see near 6% 30-year fixed. Speaking of kind of where the 10-year might go in the future, a lot of it depends on, obviously, what happens with the labor market for sure, and maybe some of the decisions that happen inside the Fed. Treasury Secretary Bessent is calling for a review of the entire Federal Reserve. So going into next week's meeting for the FOMC, you're gonna continue to see a back and forth between the current administration, which Scott Bessent is part of. He's often seen as the the level head of the administration, Treasury Secretary Scott Bessent. He's also been floated out there as potential shadow chair. He's suggesting a review of the Federal Reserve that will go beyond the current controversy over building renovations. Of course, the Fed spent $2.5 billion on their HQ, but look at the overall function. Comments come amid an intensifying conflict between the White House and the central bank. Bessent backed the idea that the Fed probably should be easing with inflation mostly moderate, inflation mostly coming down. Inflation, we're 3 months into the tariffs. Okay, there's some data now that has been kind of mixed into this inflation recipe, and we have not seen inflation take off. We have not seen that happen. That's the concern from the Fed. Has the organization succeeded in its mission is something that Scott Bessent is asking. If this were the Federal Aviation Administration and we were having this many mistakes, we would go back and look at why this happened, right? One of the big mistakes the Fed made was not reacting to inflation at the beginning. What did Jerome Powell call it during the beginning of the Biden administration? This is transitory. Don't worry. Nothing to see here. Print a little bit more. Last week, obviously, there was the back and forth between Trump and Powell. Powell is adamant that he will not be leaving his posted position. It's a position that Trump appointed him to during the first administration. President Trump solicits a whole range of opinions and makes a decision, is what Bessent said when asked about the Wall Street Journal report that he had helped convince Trump to stay his hand on Powell. So he takes a lot of inputs. At the end of the day, it's his decision. Obviously, there's a lot of belief that Trump does not have the authority to make the decision to remove Powell. That would obviously go to the Supreme Court, and the Supreme Court would step in and say, no, that is one position you can't remove is the Federal Reserve. Obviously, this position is up in May, and Trump will have the ability to name the next Fed chair person. If Trump were to say this is who the successor is now, it creates that shadow environment where the markets will start to look at the next chairperson and maybe start pricing some of that into the market. Right now, get ready for another week of back and forth between the administration and Jerome Powell as we head into the FOMC meeting next week. 10-year is down again just slightly. The 30-year came down a tick on Friday heading into the weekend from where it was on Thursday, 6.81. The weekly moved up a tick from 6.72 to 6.75. That's the Freddie Mac 30-year fixed weekly. And CME Group is saying don't hold your breath with 9 days away from the FOMC meeting. 95% chance that there will be no change to the federal funds target rate as they make their decision next week. 4.7% chance that there will be a move down. 96% chance according to the Poly Market. No change. The Poly Market and CME Group fully aligned that there will be no change to the federal funds rate next week. All right. Tomorrow, BAMX members doing our live role play tomorrow, 9 a.m. Eastern before the hot sheet. Just go to your calendar here and jump into the live role play. Members only, myself, Tom Toole, Lisa Chinati, inside of BAMX, school.com/BAMX, 9 a.m. Eastern tomorrow, right before the hot sheet, as well as all of our content, our weekly content drops, our hyper-local templates, as well as all of the hot sheet drops each and every single day inside of your hot sheet classroom for BAMX members, including this week's top 10 housing markets for cash offers, brought to you by Zudelio, which every BAMX member gets their Zudelio platform included in their membership. Denver, Colorado, Las Vegas, Fort Lauderdale, San Diego, Atlanta make up your top 5, top 10 housing markets for cash offers over the last week. Phoenix, Sarasota, Tampa, Dallas, LA wrap up your top 10. So if one of those markets, hey, you're saying, hey, Tampa, it's been beat up on price. Well, there's still a lot of future desire to invest in Tampa. It's a top 10 housing market for cash offers. That's one way to make sure that you're educating your client. Hey, not everything's over in Tampa. There's a lot of interest moving forward. And if you're interested in joining a BAM event, our only in-person event, September 24th, BAM Camp, bamcamp.live. Go to bamcamp.live to make sure you secure your ticket there. All right. I'll see BAMX members tomorrow, 9 a.m. Eastern time on the live role play, 6 a.m. Pacific time. And then the next hot sheet, which will start immediately following that, 9:30 a.m. on the East, 6:30 on the West. Till then, have a great Monday. And of course, toodaloo.